So wait me just a minute. So, yes, Mr. Elias, as I told you, uh, for this semester we have a new WebEx system, and that system is doesn't allow the students to chat among your students. I mean, with the class. You can post your chat for me only for lecture for host. So it's not possible to chat to others. But it's fine because you can chat me your question and I tell to everybody your questions. I just read it. I hope that would be not so big problem. Oh, in other subjects, but you know you have two kind of system. It's a news for finance one, and the old system they use for the rest of other lessons. So just a moment, I will ask the Mr. Said about this question because maybe it's true. So, as you remember, I have given you the homework based on trial balance, and I received some of you assignment, which is done, but probably most the wrong. So now we try to have a solution for our homework. So I just prepared you the presentation based on the definitions on accounts. Then we'll try to see what is accounts, what kind of accounts we have in the balance sheet. So and you try to understand and to remind it. I think let's start to see the homework first, then we continue our theory part. Yes, some of you have some questions from the first homework. You just ask me. You just chat me on which accounts you have the question. I was thinking that we already have a solution for first homework. You have so far, so let's back it after the homework number 2. It's all right for you? So I'm going to share with you our homework for the session number 3, which was last time, with the solution for those exercises. So practical exercises, we're going to do it right now. So let's see. I have to say that I received around maybe 10 assignments from the students, and only 2 students have done right those assignments. Only 2 students with the correct answers. right now we are going to see the true answer, the solutions for exercises, and um, you can check it, monitor it, and with your homework, and then you will see have you been wrong or no. Yeah, let's see the first one. Sorry, you can see the you can see the first slide, the exercise number 1. Prepare the trial balance for the following. So here is given transaction that involving Alta Enterprise throughout the month of April 2011. So let's see what we have. Accounts in USD. So we have some capital, drawings, open inventory, the purchases, sales, salaries, and wages. And just reading the accounts. Light and heating equipment, trades, artworks, sales returns. We have purchase return, postage and telephones, discount allowed, discount received, insurance, motor vehicles, cash in hand, accounts receivable, and accounts payable, and also bank overdrafts. So you have a list of accounts with the amounts, with the figures in USD, right? And you must, the homework given you to prepare the balance sheet means you should to separate those accounts on credit side with the debit side. So let's see, we have here is the solution for exercise number 2. I hope that the figures is not so small for you, because the list of accounts is too big, and I try to put it in one page. So can you see clearly what we have for the solution for exercise number 1? Yes, right? So we have a capital. Capital is our equity, right? The shareholders' equity. So we put on the credit side. When the capital will increase, we put always on the credit side. 8,950, 8950. So we have a drawings. Drawings is our expenses. They are things like expenses that money was taken from the accounts. So when expenses are increasing, we put on the debit side the 1,050, right? So next one, we have opening inventory. What is inventory? Inventory, so let's see, we have some definitions on them. Accounts. I have prepared you the definition on each account, so you must be able to understand what is actually. So let's see, here is inventory. This represents the financial investment that the company has made in the manufacture or production, or in the case of retail store, the purchase of product that will be sold to customers. For manufactured goods, this amount is represented in 3 categories: finished goods, work in process, and raw materials. So this means that the inventory actually is investment of the company to the production. We see inventories are like, you see here is given examples. The finished goods, work in process, raw materials, all are inventories in the production company, in manufactured goods. If we have some retail store, just a trading company, our accounts will be called like purchases. So purchasing. So, and here is in the solution for exercise number 1. Have you seen the open inventory is given on the debit side? This is our active assets. Sorry, this is our assets. Open inventory, our current assets. We always put on the debit side where they increase. The 3725, right? Yes, it is. Actually, inventory is assets. Next one, we have purchases. As I told you, as inventory, this is also our assets we put on the debit side when they increase. 23,100, right? Next one. So next one we have sales. As you know, sales are like a revenue, and we always this is like our revenue means our capital. We always put on the credit side when it increased. 34,425 we have. Next one, we have salaries and wages. Salaries and wages is our expenses, right? We pay for our staff. It's expenses. When expenses increase, we put on the debit side. Always like expenses on rental, like expenses for electricity bills, telephone bills, same. Next one, lighting and heating. This is like, as I told you, utility expenses means electricity, heating expenses. Also, we put on the debit side when they increase. We have equipment right here. Equipment also we put on the debit side because it's our assets. When it increases, we always put on the debit side. So let's see on the definition on our equipment. Just a moment, we want to show you. I should have here is. Equipment, actually, this is the fixed assets. And in the equipment, we include the lands, the buildings, the machinery and equipment, you see, the vehicle, the furniture and fixtures. So the equipment when it increase, we put on the debit side. So next is the freight outward. That means we have some freight, yes? We have some freight. It seems like a purchases. We do some, we send some goods outside. And as purchases, same as open inventory, we put always on the debit side when they increase. For 230. Next one, we have sale returns. What that means, sale returns? As you know, before we had the sales. Sales we put on the credit side, right? As our revenue. But this is return. That means the some money, the 105 USD, have been returned to have been repaid to the company, paid back means. And we must put on the expenses that the sales haven't finished yet means the money is still in the company. The goods that we are going to sell is still in the company, and we put it in the debit side as it's like seems like our expenses because we haven't get money from that sales. And we put on the debit side when it increased. Here, you must remember, when you have sales on returns, you must put on the debit side, not on the credit side. Okay, I have some questions that Mr. Barak asking that the rules for debit and credit. Let me finish this exercise and then I explain to you. So next one, we have a purchases return. You see, purchase return. As you remember, purchases before that we have put on the debit side when it increased because it's like our cost on goods. But here it has been returned that onto the company. It comes in the account of the company. The money being returned to the company's accounts. And we must put on the credit side as it seems like a revenue, like our profit that is being paid back for us. Next one, we have postage and telephones. This is also our expenses, the company's expense always put on the debit side. Has increased for 350. Next one, we have a discount allowed. That means we are giving a discount for our customers. So when we give to the discount for our customers, we always put on the debit side because it seems like our expenses. Because we make a discount, we make a price lower than on the market price, and when we do, and this is when we have let's just so I want to say that when we have a difference between the market price that we are selling price with the price that we are giving to our customers, specific maybe customer, and we are giving, that means we are giving to him some discount, and we put always the discount a lot on the debit side as our expenses, that we sell the products on the lower price as actually we do. So I hope this one you can understand. Discount allowed, that means we, as I am director of a company, I am given to discount to my customers the lower price for product than I do it to others, I mean in the market, for example. And when I sell my products on the lower price that is like fixed for some period, that means the difference between the market price and with the price that I'm giving to customers seems like a discount. Next one, we have a discount received. That means we have received, as we are a company, we received some discount from the product that we bought. And this discount seems like our revenue has increased, and we put on the credit side. So you must understand the difference between the discount allowed and discount received. Discount allowed, that we are given to discount for our customers, and discount received, that we have received discount from our suppliers. For example, we have received discount, that means we receive some benefits, like seems like our revenue has increased. So next one, insurance. We have insurance. Insurance is our expenses as salaries, because we buy insurance, we make expenses. So we put on the debit side when it's increased. We have motor vehicles. It's our fixed assets when we buy some cars to our company. Let's see, we have some definitions on that. You see, we have machinery, and here is vehicles. This is the trucks, tractors, and trailers. The company cars used by salespeople or managers, and rail cars owned by the company are included in this category. So this is the cars or tractors, some special maybe cars the company used for businesses. And it is our fixed assets. It's under the fixed assets. And when our fixed assets will increase, we put on the debit side. So we have here is 1474, right? Yes, this is yes. Mr. Barak says that is for long term, right? Of course, the cars we use for more than 1 year. When we use the vehicles, the equipment for more than 1 year, it seems our fixed assets. So we put on the debit side. So next one, we have a cash in hand. Always when we have a cash in hand, cash in bank, or cash in accounts, we put on the debit side. That's our assets. Next one, we have accounts receivable. As you remember, the last time I have given definition for you. Here is I have someone. Just a moment. So here is given a very good definition. What is accounts receivable? When a company sells products to its customers, it may receive immediate payment, right? This may be done through a bank draft, a check or credit card, or a letter of credit, or some bank transfer, or in the case of supermarket, by the cash. But on the other hand, as part of the selling process, the customer may be given the opportunity to postpone the paying for the products or services until a specified future date. This is referred to as giving the customer credit. So when the company sells product, the customer may pay later, not for today. Well, if he makes the sale for today, he may pay later. We can give him like a credit. And this is calls our accounts receivable, that the money we must receive that money in the future, but we haven't received it yet. And another one here is definition given as account receivable is the accounting term that describes the value of product delivered or service provided to customer for which the customer have not paid yet. So the typical time period the company's wait to receive this fund is 30 to 60 days. It is like when companies sell some product, the customer can make a payment between the 30-60 days, means later between the 1-2 months. So, and when we have the accounts receivable, it's like means we are going to receive this money, but haven't not yet. We put always on the debit side, because it's our assets. That money comes in the bank. So after that, when we receive this money, when it have been paid already, it will be looked at like sales, and the amount comes to credit side, because it's already our revenue. But when we haven't received it, we call it like accounts receivable and put them on the debit side. You must remember this. So I have some questions. Try to read. So any item that make expense put in the debit side. Ms. Masuda says, yes, right, Ms. Masuda. Any expenses, any cost of goods, for example, we always put on the debit side. So another question I have from Mr. Elias, does it mean that the customer owes to the company, I mean the accounts receivable? Yes, the customers owes money. No, this is not that the company owes money to the customers, that we are given a credit to customers. So, and from Mr. Akmal, I have question that when the account is already paid, when we put it then, where we're going to put. So as I told you just now, when we already received this, for example, the accounts receivable money on our accounts, it changed to sales, means the accounts receivable statement changed to sales, and we put this amount on the credit side as our revenue has increased. So what kind of question I have? So, okay, that's fine, yes. So, let's see the next one. Next one, we have accounts payable. we put on the credit side the 49.25. Let's see the definitions. I have a good definition for this term. So here is accounts payable. The accounts payable are amounts owed to vendors or suppliers for products delivered and service provided for which payment has not been made. The company has purchased these products and services on credit. This is a different situation. Vice versa situation means now a company takes a credit and postpone its payment to the suppliers. And the suppliers have agreed to postpone the receipt of their cash for a specified period as part of their sales process. Normally, this money must be paid within a 30-60 days time period. So this is a different situation. When the company getting a credit, takes a credit from the suppliers, and the postpone is payment. And here is we have accounts payable. That means you see why we put this money in the accounts payable on the credit side. You remember the credit side is always includes our liabilities that we must pay to somebody, our liabilities like credits, loans, debts. And next one is our capital, the stakeholders' equity capital. So we put on the credit side because this is money still in our accounts. We have not paid yet, and we put on the credit side as it's our liability, our credit to somebody. We have to pay. And when we make a payment, of course, this amount will change to purchases, you see. When we do already the payment, the statement will be changed to accounts which call purchases, and we put this amount on the debit side. We put the 49.25 on the purchases side for the debit side. Okay. So this next one, we have a bank overdraft. That we have taken some loans from the bank. We owe some money from the bank, $975 US. This is our liabilities that we have to pay somebody, and we put on the credit side. So you just must remember always on the credit side, we put our liabilities. I mean our, when I say our, means the company's liabilities and company's capital. Capital is investments and revenues, the sales. And on the debit side, we put our assets. Assets is what is assets? Our cash in the bank or cash in hand. It's our expenses, any expenses that we do. Rental, utility, telephone, the insurance, it's all called expenses. Our purchases, also our expenses that we have. We buy some products, we do some expenses, purchases, inventory, all our expenses, and we put on the debit side. So I have some question. What is the debit? The question: what is the bank overdraft? The bank overdraft means the credits from the bank. That company taking some credits from the bank, small credits. When it's a bank overdraft, it's the small credits, around for 1 year only. So have some another questions? Yes, sorry. Yes, from Mr. Akmal. He says that in the case if we already made the payment to the customers, then we have to put in the debit side, right? Yes, it's the question about about the accounts receivable. Yes, right, right. Accounts receivable. Yes, when accounts receivable means that when the money is, we already made a payment to the customers. It's already made payment. It's already done. We put like as purchases and put on the debit side. Here is. So now we have, let's see, we have a total amount. Total amount here is, for debit side, 60,579 in US dollars. And on the credit side, we have 49,880 US dollars. So again, we have no any balance, but our trial balance must be balanced, means must be equal. The debit with the credit side must be equal, right? So as you remember our rules, we must take the higher amount and deduct from the lower amount. Then we will carry the balance down for, you see, 10,699. And after the balance have been carried down, we have the equivalence with the debit and credit side, 60,579 in US dollars. And you must always put that the balance brought down for 10,007 or 700, around 700. And this amount goes to the next month. This month was the April, and this amount goes on the April was the next month? Oh, May, sorry. Yeah, a little confused. So, this the 10,699 in US dollars goes to the next month, and our balance starts from this amount from the debit side. We put on the debit side, as we have increased our expenses for 10,000. So I hope this exercise you have to understand the solution for exercise number 1. Yes? Cash. I have a question about the cash. Here is cash in hand. This one we put on the debit side. So I would like to offer you first see the definition on accounts. Each one we try to understand each one, and then we continue with our exercise number 2. Let's see, because that would be very, it will be more efficiently for you to do the next exercise. Mr. Park asking what this amount, the 10,700, around 700. This is money. It's not a cash. This is amount seems as our expenses, because we have brought down our balance for this amount. So next time, when we start the next month, we put this amount on the debit side, and the debit side already will be increased for 10,700. So you must understand that always our expense in the company, our expense is always more than our capital and our investment, that money we have in the company. You must understand that in the family budget is always like this, like expenses becomes more than our earnings, right? And when we have the expenses, when the expenses amount is more less than our earnings, our profit means, we take some credits or loans from the bank or from our next salary. I mean, the salary from the next month. We take some advance and so on. So somebody wants to talk. I can see that Mr. Knight Michael wants to talk. Okay, just want to give you a microphone. Please give me a minute. Try to find you first. Okay, I can see your hand. Hello.
Hello.
Yes, Mr. Navid.
Hello. Good afternoon, Ms. Alia. Thank you very much for allowing me to speak. I've already put some statements for you, but I think our other classmates cannot see it. It was better if all of us saw that. That would have made it easier to understand what is debit and credit. As I learned from other books and reading the books, there were some easy ways to understand what is debit and what is credit. That makes very understandable for our other classmates. If our classmates hear me, I would say like we can make the word debt, D-E-A-D. Debt stands for debit, and what are the debits? Under debit goes expenses, assets, and dividends. Expenses, what we spend, and assets, what we have in our like fixed assets and so on. And dividends are the interests of the shareholders. When we give the interest, it's also like expenses to our shareholders who are working, who are owning the company like with us. And the other easy understandable word acronym for to understand what is credit, how we can put the things under credit, is CLOR. C-L-O-R, CLOR. And in that we have C stands for credit, and L stands for liability, O stands for owner's equity, and R stands for revenues. Anything under liability, owner's equity, and revenues goes under credit. That will make us, for us, easier to make the trial balance or balance sheet filled and understand the different accounts and then putting them on the right place, on the right. And there is also some examples like the we can also have the T accounts, and like to understand, like on the left always is debit, on the right is always credit. And the other formulas we can put on the equation, the accounting equation, we have the assets, liabilities, and capital. There's another formula, so there's no time to talk more on that. But I think it's better to remember the word acronym debt and CLOR. Debt, debit, expenses, assets, and dividends. Dividends are the interests of the shareholders. And CLOR, credit, liability, owner's equity, and revenues. I think if you please can put these mem to the board for our other classmates to see, it's easier to remember and makes it very understandable and easier to always remember and to put it correct. Thank you very much.
Thanks a lot, Mr. Navid. Just going to post your recommendations. Here is. Thanks a lot. So Mr. Navid given recommendations for you for the formulas that we use. Here is for debit side. He said DEAD is the debit, expense, assets, and dividends, right? And for the credit side is comes CLOR, the credit liabilities, the owner's equity, and revenues. And you must remember that revenues is also our sales. Just wanna revenues equal to sales. So sometimes we put the accounts in the accounts. We put the word revenue or sales. So yeah, it's great. Thanks, Mr. Navid. I have seen your homework. That is very good job. So, and let's see the accounts. I wanna give you some definitions to try to understand each account, and then we move on to exercise number two. Here is. So we are going to start from the cash. So definitions of main items in the balance sheet. Cash. What is the cash actually? The cash is the ultimate measure of an organization's short-term purchasing power. Its ability to pay its debts and to expand and modernize its operations. It represents immediately available purchasing power. Its primary characteristic is that it is immediately liquid, is available to the firm now. This account may also be called as a cash and cash equivalents or cash and marketable securities. So when we have a cash, this is our assets. You must remember. Sometimes the cash is called like cash equivalents or the marketable securities. You maybe have some this kind of statements like marketable securities or cash equivalents in the balance. And you must understand that is the cash actually. So cash equivalents are securities with a very short maturities, perhaps up to 3 months, that can be earned some interest income for the company. Cash equivalents, like we see the next one. Here is given some definitions. So the cash or cash equivalents. Cash, it could be cash in hand, just money. I mean the coupures like money, and we have some cash equivalents that the special papers. I mean securities that could be very fast changed to the cash in money. I mean, they are really they have high liquidity. So here is what is a marketable securities. This category includes the short-term investments that companies make when they have cash that will not be needed within the next few weeks or months. So this is actually the company's investments, very short investments, around for a few weeks only. And the securities that can be placed in this category include the certificates of deposit. Maybe you have heard about this. The certificates of deposit, CDs we call, the treasury bills, and the commercial papers. All have very short maturities, usually 90 to 180 days for 6 months only. The 3 to 6 months we have these kinds of securities. And CDs are used by the commercial banks, treasury bills used by the US government, and the commercial paper is used by very large, high-quality industrial corporations. And purchasing this high-quality security, which generally have little or no risk, gives the company the opportunity to earn interest on money that it does not need immediately. So cash and marketable securities, they are our assets. They could be cash in the bank, in our accounts. They could be like cash in the hand already, money like you have in the pocket. And they could be like a cash in the papers, like security papers, that you made some investments on the big company, and from this you can earn some interest. So let's see the next one. We have accounts receivable that I already I have given you the explanation. This is when a company sells products on the credit. So it means you are a company, you are selling products, but you are not taking the cash immediately. You will get it later in the future. But always during 1 year, not more than 2-3 months only. This is accounts receivable. Next one, this is same as I told you, 1 to 3 months would be. Inventory, this is a financial investment that the company made for production or manufacture. As I told you, that it could be purchases, finished goods, raw materials, or our inventories, like seems like our purchases. So, and this is our assets. Let's see the next one. We have what is the current assets? So, we have seen the inventory, account receivable, market securities, and cash. These all accounts calls like current assets. This is a sum of the asset classification previously identified by the cash. We have given cash term, the marketable securities, accounts receivable, and inventory, plus a few more minor categories. So this is the main our current assets: the cash, marketable securities, accounts receivable, and inventory. And these assets can be very fast would be changed to the cash money. They have a high liquidity. You don't worry, I will send all those slides for you. So next one, it represents the assets owned by the company that are expected to become cash within a 1-year period from the date of balance sheet. So current, you must do remember that the current assets is all the assets that been could be used during the 1 year. That means we can change this kind of goods to the money, cash money, during the 1 year, not more than it. So this for I think this presentation I haven't sent it to you. I will send it today later after class. You have only the homework assignment only, and you don't have any solution for homework and those definitions. Oh, if you have the definition, that is okay, good. So current assets we have seen. What is that? Next one, what is the fixed asset? The fixed assets are assets owned by the company that are used in the operation of the business and expected to last more than 1 year. Don't worry, if you haven't received those presentations, we'll send you again. So let's see, we have some list of fixed assets. You must understand what is the fixed assets. Is the land, buildings, machinery and equipment, vehicles and furniture and fixtures. What is the land? This can be the site of an office, factory or warehouse, or it might be vacant and available for future use. What is buildings? This includes any structures owned by the company, such as factories or other production facilities, offices, warehouses, distribution centers, and vehicle parking and repair facilities. This is all called buildings. Machinery and equipment. This category includes all production machinery, office equipment, computers, and any other tangible assets that support the operation of the company. Vehicle, the trucks, trailers, the company's cars used by the salespeople or managers. And the furniture and fixtures, this also includes leasehold improvements to real estate on a long-term lease. This is our, like in the offices we have tables, chairs, and so on, our furniture in the office. This is the main list of the fixed assets you must remember. So, in this, you must remember that those assets are using during the more than 1 year. Uh, so, accumulate depreciation. Uh, when you have a fixed asset, you always do some depreciation on that, because the amount of the fixed asset in the balance sheet would be shown as a historical amount, the amount that you bought on that time. And you must do accumulated depreciation, that we have some expenses on the repair those fixed assets, and we must put it on the trial on the income statement also as a depreciation. This is sometimes called the reserve or allowance for depreciation. It is the total amount of depreciation expense that the company has recorded against the assets included in the gross book value. When tangible assets are purchased and recorded on the balance sheet as fixed assets, their value must be allocated over the course of their useful life in the form of a non-cash expense on the income statement called depreciation. So, the depreciation we put on the income statement. Later we learn what is the income statement. We won't put on the balance sheet, because on the balance sheet we always put our the real expenses. But for our fixed assets, we make some reserve, special reserve, because our fixed assets will be used over the sometimes 3 to 10 years, maybe more than it. It could be different time, and we always must do depreciation on that, do reserve for those fixed assets, because their price on the market, when we buy some, for example, the company bought some car, the cars you're using in the company during the 10 years, for example. Of course, you must do depreciation, like make a reserve money for this car, because you do some repair, you cost some money for this car, you do some repayment or something else, and also the price on the market will be decreased. And why we do the depreciation reserve for the fixed assets? Yes, and this kind of fixed assets, they lose their value during the time, in the quality itself, and the price also will be decreased during the time. And we do some depreciation. Depreciation we show in the income statement. And some asking me how we can calculate the depreciation for the cars and equipment. For this, we will move on the next session. I will give you the formulas how to calculate the depreciation. We have a few methods how we can calculate the depreciation for all of fixed assets. Of course, it would be in percentage, and it also perhaps depends on time value of the time life of the fixed assets. So next one, liabilities. So liabilities are the amount that the company owes to others for products and services it has purchased, and amount it has borrowed and therefore must repay. So this is that money companies owes to others. That means company must pay for others taking some credits or loans or debts. And we have two kinds of definitions: the current liabilities and long-term liabilities. What is the current liabilities? It include all money that the company owes that must be paid within 1 year from the date of the balance sheet. This is short-term liabilities. Like we take some credit based on the short-term period. And long-term liabilities are those that are due more than 1 year from the date of the balance sheet, when we take some like line credits, for example, from the bank. So sorry, I have some questions. I have to read them. Yes, Mr. Bach said that liabilities are existing debts and obligations, such as notes payable, accounts payable, salaries payable, rent payable. Yes, you are right, Mr. Barak. And I have some questions from the Mr. Barak Akmal, how we can calculate the depreciation. We do it later on the next session. First, we must understand the balance sheet and income statement first. The meanings of the accounts. Now, we have accounts payable. If the accounts payable are amounts owed to vendors or suppliers for products delivered and service provided for which payment has not been yet paid. So this means that we are taking some credit from our suppliers. Means we are taking some credit to postpone our payment for products that the company owes some money. This is accounts payable. So it's normally that like a short-term credits, like we take for 1-2 months only. So I hope you do understand what is account payable. We always put them on our credit side because this money we haven't paid yet. We take a credit, we postpone our payment. Next one. What is the bank notes? This amount has been borrowed from a commercial bank or some other lender and has not yet been prepaid. Because the amount must be repaid within 1 year, it's classified as a current liability. I hope you do understand that the bank note, this is the borrowed money from the commercial bank. That I am a company, I borrowed some money from the bank and I haven't paid it yet. This is a bank note. I borrowed money from the bank. And also bank overdraft, it seems like a bank note, same as you had previously exercised. The bank overdrafts, the term equal to bank notes. The short-term credits from the bank. Just a moment. Short-term credits from the bank we have taken. So let's see, the bank overdraft is a bank note, same as a short-term credit from the bank. You must understand. You can just make some notes about this statement. So next one, what is a long-term debt? This long-term debt is amount that were borrowed from the commercial banks or other financial institutions and are not due until some time beyond the 1 year. This is a long-term credit from the bank that the company, when company gets some loan credits from the bank for long-term, more than 1 year. And this category may include a variety of long-term debt securities, including debentures, mortgage bonds, and convertible bonds. So next, let's see the next one. We have what is stockholders' equity. Stockholders' equity is same as the shareholders' equity. Because sometimes you could be confused with the terms, but right now you must remember those one. Yes, just a moment. Typing you the same things. So let's see, the shareholders' equity is the stockholders' equity, same things. So what is stockholders' equity? It represents the cumulative amount of money that all of the owners of the business have invested in the business. That, like, I'm shareholder, I am stockholder, same stockholder or shareholder, I can call it how much money I invested. This is my equity, that money that I have invested in the business. And remember that the amount shown for preferred stock, common stock, and retained earnings are the historical amount that the company received when it sold those securities and retained the profits. So that means in the income statement, we always show the historical cost of our investments. For example, in the 2005, I have invested 100,000 US dollars to the company, just example. And we have income statement for 2012 year, for this year. And in the income statement, I must show the money that I have invested the same at those periods on the 2005. Like we show the historical cost, historical investment in the income statement. What is the retained earnings? The portion of the total profits of the company that the owners have reinvested in the business during its entire history is called retained earnings. This means, like, for example, you have invested some money. After a few years, or 1 year, it depends on your business, you've got some interest, you got some benefits from this business. And when you have some interest, the dividends, which we call the dividends, and when you reinvest these dividends to the company, you won't take it to your own expense, to your own pocket. You just leave it in the company for the business. Means like just when if you would like to develop your business, you can leave your dividends in the company's accounts. And when you do like this, this money calls retaining earnings. Retained earnings. Here it is. But if you you draw this money from the company accounts, you will check in your pocket. Maybe you want to spend it for holiday, for example. And this money calls like dividends, the stockholder interest, like dividends, and will be seen like expenses, like cost of the company. So, and here is given, okay, collectively we have some preferred stock, common stock, and retained are known as shareholders' equity. So, you want to remember that stockholders' equity, what it includes? It includes the retained earnings, the preferred stock, and common stock. This is the common stock, preferred stock. They are the difference between them. Depends on the dividends. We have some fixed dividends, or we have changeable dividends. So next one, let's see what the balance sheet. I have some questions. Sorry. Retaining earnings will come as a credit. Yes, right. The retained earnings come as a credit because this money seems like revenue, and we haven't draw it from the company's accounts. We just leave it in the companies for the businesses, and we show on the credit side. I have another question. Sorry. asking me, Mr. Akmal, can we call the profit we made retained earnings? Yes, when we do profit, profit includes, we have some net profit, gross profit, right? Profit includes the interest, the dividends we haven't paid yet. And retained earnings, they are inside the profit. You must remember. They still, the dividends that we must pay to shareholders, they inside the profit. But when those people, shareholders, I mean, they leave this money in the company, we call them retaining earnings, and we won't put on the profit. It comes on the credit side as our additional revenue, I mean. So let's see the balance sheet. Because we are getting back to for the definition of balance sheet, because I want to show you some examples based on the balance sheet. Because before we have we prepare the trial balance which comes before the balance sheet, the trial balance. First, the account, any financial or accountant, they prepare the trial balance, then he or she prepared the balance sheet. After that, the income statement and cash flow. You must remember. So, what is the balance sheet? It is a financial statement that summarizes the company's assets, liabilities, and shareholders' equity at a specific point in time. These three balance sheet segments give investors an idea as to what the company owns and owes, as well as the amount invested by the shareholders. So, here is says that we have three main segments of the segments. We have three main forms. The financial form that shows the company's financial position. It's what it is. Its main assets, liabilities, and shareholders' equity. The three segments that shows investors how much we owe and how much we own. So the balance sheet must follow the following formula. If you remember, assets, you must remember assets equal to liabilities plus shareholders' equity. Shareholders' equity. The word is equity must be here, but sorry, I think it's not enough space for those formulas. That's okay. So you remember, just a moment, you remember the liabilities and shareholders' equity is our credit side, right? Right hand side is a credit side. And our assets is our debit side, as I told you. So, and debit side must be equal to credit side, right? That means the asset must be equal to liabilities plus shareholders' equity. Here is the word must be equity. So let's see, I have some example for you to show the sample of the balance sheet. And you can understand how we prepare the balance sheet. The balance sheet is a little different from the trial balance. The trial balance that we, like it's our notes, we prepare a trial balance first, and then all these amounts and figures will move to the balance sheet. You must do understand like this. Some asking me that we forgot to see the homework number 2. No, we haven't. I didn't forget about this because I wanna finish with this definition first, and then we move on the exercise number 2. Okay. We have not enough time. Okay, I'm going to back. Just a moment. Standard. So the balance sheet, standard company balance sheet has three parts: assets, liabilities, and ownership equity. And the main categories of assets are usually first and typically in order of liquidity. So let's see. The sample small business balance sheet. On the left hand, we have assets. As you can see, we have assets. What is the assets? Our cash, our accounts receivable, and tools and equipment. This is as examples, right? And on the right hand side, we have our liability and owner's equity. Is the credit side, right? You must remember, it's our liabilities, our notes payable, accounts payable, the capital stock, and the retained earnings. This is our liabilities and owner's equity. So this is how looks balance sheet. The trial balance looks a little bit different because our it's like a list of some accounts with two sides of debit and credit side. But balance sheet seems like trial balance, little bit same. On the left hand side is always our assets. Our assets is our debit side. We must remember the company's debit side. Debit side. And our right hand is the credit side. As you can see, I have typed some words, but I mean, I have to change the color. As you can see, the debit side, left hand side is cash, accounts receivable, tools and equipment, right? And the credit side is liabilities, notes payable, accounts payable, capital stock, and retained earnings. So in the total, we have some balance, the equal with assets, which is 37,800, equal to liabilities and owner's equity, right? The amounts are same, must be equal. This is our balance sheet, how it looks like. And I have another example on the balance sheet. For example, it's same as we do trial balance. The left side is a debit side. Debit side, you must remember, debit side, and the right side is a credit side. Here is. So, and what we do have right here? We have on the debit side cash. We have accounts receivable, inventories, and all these three kind of lists calls total current assets. Another, we have fixed assets like a property, plant, and equipment. This is total fixed assets. And the total will be 100 USD, total our assets. So let's see on the credit side what we do have. We have accounts payable, 10 USD, short-term debts, 20, and it's our total current liabilities. And we have some long-term debts, long-term credits for 20 US dollars, and we have a shareholders equity for 50 US dollars. And total claims on assets, that means total liabilities plus equity will be 100 US dollars. So we have, as you can see, we have a balance between right and hand side. Here is 100, here is 100. This is balance sheet how it looks like. It seems like a trial balance, but we always on the debit side, the format the format is actually a little bit different, but always left side is a credit and right side is a, or left side is a debit, sorry, and right side is a credit. You must remember this one. Yeah, that is okay. I hope so you can do understand. I have some definitions on the income statement, and we have time. So let's back on the practical exercise. Then we continue with the income statement. So let's back on the exercise number 2. So exercise number 2: prepare the trial balance for the following: the transactions involving Cascade Enterprise throughout the months of June 2008 are. So in the accounts we have capital, inventory, accounts receivable, accounts payable, sales, purchases, sales returns, purchase returns, discount received, bills payable, rent payable, insurance, drawings, land and buildings, freehold property, plant and machinery, PT expenses, cash at bank, furniture, freight, wages, salaries, advertising, postage and telephones, and general expenses, right? So right now we have to prepare the trial balance from these accounts. Let's see the solution. As you can see the solution, I hope this is not small figures for you. You can understand. So capital is our equity, right? And we put on the credit side when our capital will be increased. Like here, capital. Inventory is our assets, right? Our current assets we put on the debit side. Accounts receivable we always put our debit side is our expenses. That the customer that means we are given credit to customers and they haven't paid the money for us, and we show in the debit side as our expenses. Accounts payable always comes on the credit side, that money we haven't paid to our suppliers, right? Sales is our revenues we show on the credit side when it increased. Purchases, we have purchases is our expenses. We buy some products, means we buy some raw materials, for example, and we put on the debit side. This is our expenses. We do expenses. The sale returns also is our expenses because we have sold some products and then we return some products, and it means that money, that the goods it comes back to the company. Purchases returns. This means we have bought some. We buy some products and then we return to our suppliers, and we show in the credit side as our let's say like our benefits. Discount received. Discount received, that means the company receives some discount from suppliers, and means like our revenue has increased, we put on the credit side. Next one, bills payable. Bills payable, you must understand, is same as the accounts payable. That we must pay. We have some liability. The company owes money. That company must pay to somebody and haven't paid yet. Must do it in the future for 40,000, and we put on the credit side always because it's our liabilities. Rent payable, same, that we must pay for rent, but we haven't paid it. We postpone our payment for rent of the buildings, for example. We do it in the next month, and we must put on the credit side because it's our liabilities has increased. We owe some money, and after that we have all in the debit side because it's our expenses. Let's see, insurance. We buy some insurance. That means we do some expenses. Money goes out from the company. We put on the debit side. The drawings. The stakeholder drew some money from the company's accounts. We put as expenses. Land and buildings is also our expense, like equipment and land buildings is our fixed assets. Like expense we made some payment. Freehold property, also we bought some property, we put on the expenses on the debit side. Plant and machinery, same as our fixed assets, is our expenses. PT expenses. PT expense means like some small expenses. We do some small expenses, maybe the expenses for taxi, for something, for telephone, for cell phone, and so on. It's called the PT expenses. Cash at bank is our assets. As you remember, the cash at bank we always put on the debit side. That money we have in the bank. The furniture, also our expenses. It's fixed assets. We have do some expenses. I mean, we bought some furniture. We spent some money on that, and we put on the debit side. The freight, same. We do some freight. We sell some product like purchases. This is a freight, like you must understand, is same as purchases. This is two same. Wages and salaries that we pay the money for our staff for doing the operation jobs. This is the salaries, wages is our expenses. Advertising, same as expense, we put on the debit side. Postage and telephones, same. Utility expenses, we put on the debit side. And some general expenses, also put on the debit side. So you must remember that on the debit side, always we put our expenses, some our purchases, inventories, accounts receivable, and what else? We have some sales returns, if you have some return on sales. And the credit side, always we put capital, as you see, we put accounts payable, our sales, revenues, some purchases return that we earn some money, some discount we have received, some pays payable, rent payable, the money that we haven't paid yet, our liabilities. This is our current liabilities, the rent payable, bills payable, what else? Yes, and accounts payable. This is our current liabilities. And capital, capital purchases and purchases returns and discount received is our capital, the stakeholders' capital. So, and at the end, you can see the balance between the debit side and credit side. As you remember, before we didn't get balance from the previous exercise. We just create down it, but in this exercise we have a balance. So you don't think that we always create down some balance. Sometimes we have a balance actually with the debit and credit side, with the left and hand side. So this is the solution for exercise number 2. Who has this same solution? I'm happy for you. That means you do understand how to prepare the trial balance. So I have some questions asking me if we have some cash at hand, where we should put it. If we have a cash at hand, we put on the debit side. Always cash in the hand or in the bank, we put always on the debit side. The cash is debit side. It's never mind at hand or at the bank, because it's our assets. So any questions so far which for this exercise? So some put the discount. So let see, there's some asking me about the discount receipt. This one. Oh, sorry. So discount received. What is actually discount received? We put on the credit side. Why we put because this is a discount company has received from the suppliers, for example, that we received some discount. We got the money back on our accounts, and when we have got some money back on our accounts, we show on the credit side because it will be seems like our revenues has increased. Always when you write the discount received, put on the credit side that money we received back to the accounts, our accounts. But it's not same as a cash in bank. You must remember, cash in bank, it's a cash in bank. It's different from the discount received. All accounts are different, and they have their own meanings, and we cannot put it together all in one. So I have some questions. So some of you asking me to give you a homework based on balance sheet. Yes, of course. For today's sessions, I give you a homework based on the balance sheet around 2 exercises. And it will send you today or maybe Monday, last Monday. Today, tomorrow, because I have to prepare some 2 exercises. First will prepare you the simple one. The second one prepare you some little bit more confused, difficult, to encourage you to think about the accounts. Some ask me because some asking me that if we have a discount payable, then we put it in the credit side. Yes, always the word is payable. The word is payable when you have a discounts payable, accounts payable, the bills payable. You put on the credit side. Payable, that means your liability that you have owned the money. Type in for you. Liability equal to payable equal to credit. It means you put on the credit side. Okay, what else? So I'm asking for me to prepare you the exercise based on trial balance also. Okay, we'll prepare a few exercise based on the balance sheet and the trial balance. And the next one we have income statement, and we must do exercises also based on the income statement. Income statement would be a little bit different one, maybe a little bit difficult. First, you must understand the balance sheet and trial balance. I think that on the income statement, I give you on the next session the definitions and the exercises. Couple time. So we have 7:14. Let's try. Let's see the first the theory based on income statement, because on the next class we do some practice. Is it okay for you? Yes, the trial balance. First, you prepare. Remember, first you prepare the trial balance. You must prepare trial balance for the company. Trial balance, your company. And second, you do balance sheet based on trial balance. So income, what is income? Let's see what is income statement. The income statement is one of the three primary financial statements used to assess a company's performance and financial position. The two others is the balance sheet and the cash flow statement. The income statement summarizes the revenues and expenses generated by the company over the entire report period. The basic equation on which an income statement is based is the revenues, have you seen, minus expenses gives us net income. Revenues minus expense, net income. So let's see, here is a simple example how we prepare the income statement. Income statement we always do after the balance sheet. Income statement we always prepare at the end of the year. Let's see, we have income statement. First we show our sales. Revenues means our revenue. We show our revenue. How much we get from our businesses. How much revenue we get from our business. And then we show the costs. How much we cost to do this business. And the difference from the sales and costs give us the net income. This is a net income, our profit. Gives us our profit. So this is the simple formula. Sales minus cost give you the net income. You must remember. This is a simple example of the income statement. Let's see the more difficult one. Here is the income statement of the company XYZ for the year ended December 2008. As I told you, we do income statement once in a year at the end of the year. At the end of the year, one time only. So as you see, the total revenue, this is our sales, the 100,000. Then we show our cost of goods sold. This is if we have a production company, we always show the cost of goods sold. That's how much we spend to make these products, I mean. And then it gives us the gross profit for 80,000. As you see, 100,000 minus 20,000 gives you the 80,000. Then the next part, we show our operating expenses. The operating expense includes the salaries, rent, utilities like telephone bills, and so on. And also it shows us depreciation, our cost on depreciation. So, next one is giving you total operating expenses. Total operating expenses. This is operating expense. The total amount for 30,000. And then we have some operating profit. We show our operating profit is 50,000. It's 80. Gross profit means 80,000 minus operating expenses. 30,000 gives us operating profit for 50,000. Then we must show our interest expense. Interest expense, that means the dividends we pay for shareholders is 10,000. It's also our expenses. But we must show all this at the end of the income statement. And we must show it after the operating expenses have done. And also after the interest expenses have deducted, we show the income before taxes. We have income before taxes 40,000. That means 50 minus 10,000 gives us 40,000. And of course, as you know, in most of countries, the taxes pay at the end of the year, or in the first 3 months of the next year, the beginning of the next year. And the tax will show always at the end of the income statement. The taxes is around 10,000. And then income before taxes 40,000 minus taxes 10,000 gives us the net income. This is net income. So this is the company's net profit. How much we get? The 30,000 US dollars. And after that, we can show the number of shares outstanding. That how much shares we have. We have a 30,000 of shares. And when we calculate like this, the 30,000 of the income statement divide to 30,000 of the shares outstanding, we will get the earnings per share. That means our shares equal to $1 US. I want to show you one share. One share going to type you equal to $1 US. $1 USD. And we have in total we have in the total we have 30,000 of shares, which is equal to 30,000 USD. Just I type you. Look at this. This income statement for the most of companies, they do like this. The main items given to you right here in the company XYZ. So how you do understand this income statement? Please let me know. Mr. Navid asking you the sales equal to investment and revenue. No, sales is sales. Sales is our revenue. Investment is a different one. It won't include to the sales one. Mr. Navid, the total revenue is total sales. The investment is a different one. It won't include here is in the total revenue. The sales revenue means how much we have sold the products, how much money we get from these products. So what kind of question I have? The operating profit. What is the operating profit? Let's see. The operating profit. This is operating profit. That means when we do the revenue minus the all operating expenses and cost of goods sold. All operating expenses and general expenses. Just wanna type you what is the operating profit. Operating profit equal to operating profit equal to revenue minus the general expenses minus what operating expenses. Just a moment. This is the formula. The total operating profit equal to revenue minus general expense and minus operating expenses. As here is n- n- mm, here is Mr. Knight has a question about the sales. What is the sales equal to investment and revenues? He says that the good cost, for example, the goods cost 100 US sold. That includes our money. We put 80. That he says that when our goods we have a revenue for 100 US dollars. That means we have for 20 our expenses and 80 our gross profit. That means our 80 is not our investments. 80 is our interest. That is all, when you have a production company. Always you have some cost of goods sold. That, for example, to make some, for example, to make some book, you must spend some money for production, right? You must buy paper or make a paper and so on. And this is called your cost of goods sold, the cost of goods. And you have some cost of goods sold plus your interest, means plus you put not that calls not investment plus your the profit you won't get from this product, the marginal price, and that after that it gives you the market price for the gives you the total revenue price. For this formula we come later. You don't worry. So always cost of goods plus added value, it's cost added value, will be the revenue, the total revenue. So I just want to give you some formula just a moment. Like a cost of goods sold plus added value. You do added value. It's not called the you said investment. Just a moment. Added value equal to sales price, which is equal to sales, equals to revenue. This one I want to show you, Mr. Navid, as you asked me. Here is the cost of goods sold plus added value give us the sales price, which means sales, which means revenues. This is the same things. It's not investment, it's different one. Mr. Mohammad Ali is asking me, could you explain the interest expenses? So we have here is interest expenses is the shareholders' dividends. We pay the dividends. Interest expenses, it's dividends, the commission we pay for shareholders, dividends that we pay to our shareholders. There's some commission, the profit we pay for them, dividends. This is called interest expenses. Interest means dividends from the shares. The dividends from the shares we get, we pay for stockholders. This is called interest expenses. So I hope you do understand the income statement. Anyway, we do some practice exercise on the next session. By today, I will send you the practical exercises based on the trial balance again, on the balance sheet, around few exercises, and we'll send you some assignment based on the income statement. So you will have a huge job to do, and you must do it before the next session. Please don't forget about this. So we'll send you, I hope, today or tomorrow, those exercises. Try to prepare for you as fast as you can do it. And of course, we'll send you the presentations, today's presentations by your email. And we'll send you the presentation which is based on the next sessions also. Don't worry, we'll send you everything what you need for the exercises for your assignments. So thanks a lot. I hope you joined the class. I hope you do understand the trial balance, our solutions, everything. Please review all the presentations. Review again. When you do review a few times, you can understand more easily and faster. That would be efficiently for you to make an assignment in the future. Because our exams will be based on the practical exercises, you must remember this. And this exercise is very important. So thanks a lot. Hope you joined. I have joined our class. And goodbye. See you on the next